Good afternoon. This is Dave Konecki, editor of Ag Equipment Intelligence. Welcome to our latest webinar on Are You Ready for an Industry Turnaround? Agriculture has been and will always be a cyclical business, continuously impacted by weather, the ups and downs of supply and demand, as well as political turmoil and trade issues. This is where the industry finds itself today. But as industry veterans know, it isn't always going to be this way. Dealerships have excelled at cost containment and increasing returns on decreasing sales since the downturn. Given the high cost of growth, this webinar will explore some areas dealerships should be looking at now so that when the turnaround comes, the increasing sales do not overwhelm profits. Today's webinar is sponsored and presented by Coe Isom, the firm which has been serving the food and agricultural industry since 1932. It is a national consulting company and a top 100 accounting firm. Its locations span the U.S. from coast to coast and comprise industry experts who solve business challenges from policy to play. Today's presenters are industry champions and team leads, Marc Johnson and Clinton Baker, both are Coe principals. Before we get started with today's presentation, we have a couple of housekeeping items to share with our listeners. On your screen, there is a control panel with a Q&A icon. You can submit questions here at any time during the presentation. Time permitting, we will look to answer as many questions as possible following the formal presentation. If for any reason you lose your internet connection, or if our connection should happen to fail at some point, and it looks like the webinar has been interrupted, just go back to the email you received earlier telling you how to join the webinar, and you can re-enter the webinar in that way. Okay, we're ready to get started. Thanks again for joining us. Marc and Clinton, it's all yours.
All right. Well, thank you, Dave. This is Clinton Baker. Like Dave said, I'm a partner with the firm. I'm in our Indianapolis office, joined today by Marc Johnson. He's our firm's market champion for equipment dealerships, which means he leads the team. And he leads that from our office in Kansas City. And the picture here on the screen is of Marc and I. We travel the country together. That's actually a still shot from a video we shot called Stories from the Road. We'll talk a little bit more about that later. But Marc and I have been serving this industry for about 20 years or so each. And so we've been through the ups and downs with a number of our clients. And we're often brought in by clients to help them assess how their dealership is doing, how it can perform better. But a lot of times the question about ups and downs and trends and turnarounds and things like that kind of stems from two common sources. And so many of the participants on the phone today might be intrigued for those same reasons. You know, one of them is just because economic times do go up and down, and maybe the dealership has gotten beaten up a little bit, and so management and the owners are looking for some corrective action, or things have been going really well and dealerships are looking for how do we make sure we can sustain this. The other question a lot of times that's the impetus the other reason a lot of times that question gets asked is because there's a potential merger or an acquisition or some kind of succession planning within the family going on, and those owners and management teams are just trying to, again, figure out where are we in the cycle. As Dave said, the business is cyclical. We know that. We're going to show some charts in a minute that show the most recent one, but it's common. So a lot of times many of you probably have heard Marc and I speak about the topic from an M&A perspective, but today we're going to approach this from a different perspective. And so on the next slide here, it shows really our main bullet points for today. Marc's going to share a little bit about our firm again and some of the areas we work in. I'm going to then cover the ups and down cycles. I'll do that pretty quickly through the industry background of that. Marc's then going to share also pretty quickly about the trends and the forecasts. And if any of you logged on today hoping we were fortune tellers and had a crystal ball and can tell you exactly where this is going, then good luck with that. But I'm going to share the latest information from multiple sources that we track on a regular basis, and that way you can have that at your fingertips And then we're going to walk through two examples. And one of those examples, the first one we say is losing by winning in a rebound. And the second one is how do you survive in a rebound? And what's interesting is as many of you live in the industry, there's no magic bullet for either one of those scenarios. It's really about consistency and keeping the eye on the right things. And then we're hopefully going to leave about 10 minutes at the end, probably finish up about 50 minutes after the hour, leave about 10 minutes at the end to hopefully take some questions and answers. Like Dave said, you can type those in. Dave will collect those and then moderate that at the end. So Marc, I'm going to turn it over to you.
Well, we always like to start out with a little bit of a credibility check, just so you know that you're talking to somebody that may know what they're talking about. We think we bring a unique perspective to this just from the standpoint of who our firm is. So Clinton said I was a market champion. That's a fancy title, and our firm has a funny name with Coe Isom. But we're a firm that serves a lot of your clients. So about 2/3 of our firm's revenue comes from producers. And so we have a very unique entry point into understanding your customers as well. We've been around for almost 85, 90 years here, founded in 1932 in Middle America, Kansas, and have since grown all over the country out to California and DC. As you can see, we take up a lot of the heat map of where agriculture is in the United States. So like I said, 2/3 of our business of their firm comes from the agriculture industry, whether that is the equipment dealers like Clinton and I serve, or the farm producers, banks, ethanol plants, that kind of thing. So we know this industry pretty well, and it gives us a pretty good insight into what the economy looks like now and hopefully going forward. We're all over the country, just like everybody on this phone call. So hopefully the data we give you today won't be anything that sounds like, well, that's great for the Midwest, but how about me in the Southeast or wherever you might be, because we do deal with that and with all aspects of the production, whether it's beef or dairy or row crops or even permanent crops out in California. Got 350 employees and 22 offices, so quite a bit of experience there in bringing some solutions. This is a look at our dealership team itself. So we currently serve about 40 dealerships. That number goes up and down every year by the number of dealerships we make disappear in a merger and acquisition, which is a lot every year. But when we look at those dealers that we're currently serving, they represent about $8 billion. So as you can see that most our dealers are bigger dealers, and most of them are ag dealers. The other thing on the screen that you'll see is our services, unlike a lot of accounting firms our size, is we do a lot of consulting work. So yes, we're good at audit and tax. We're a CPA firm, so we have to be good at audit. And we're a CPA firm that serves ag producers who hate to pay taxes, so we have to be good at tax returns and tax preparation and planning, so we're good at that as well. But where we find enjoyment, where we bring value to our clients, is when we bring the consulting services, much of which might sound like our presentation today, and helping clients and dealerships understand what their cash flow is going to look like going forward, what their future equity and valuations might look like, and how they can ultimately use that in succession planning or estate planning or strategic planning to make their business better.
Yeah, so this chart here, we're going to talk about the ups and downs of the cycles. Again, many people on the phone have lived through this, but typically in the ag industry, we talk about a 7-year cycle, which is oftentimes, we hope only 2, maybe 3 years down, followed by 3 to 4 years up. Although, this last cycle has been quite a bit different than the ones before. If we go pre-2000, the 7-year cycle seemed like a pretty solid, pretty repeatable event, and they weren't major swings either. We'll see a chart later on that compares this to the construction industry, and you're going to see much higher highs and lower lows in that industry. But in ag, it was just kind of this gentle up and down, and then we have the first 10 years of the 2000s where we kind of missed a down. And so 2013, 2014 for many ag equipment dealers was at the time their high. In the last 7 years, then what we've seen, we saw, of course, a longer drop. Had about a 3 or 4 year drop, and then began a steady upslope. Now, the thing about this chart here specifically is this chart doesn't come from kind of some theoretical data or some voluntarily disclosed data or that sort of thing. It is scrubbed, obviously, to be confidential, but at the same time, this actually comes from the dealers that we work with. So it comes from audited financial statements. Obviously, most of those would come from ours. Some of those would come from some other firms before these people became clients of ours. But at the same time, what we've actually have seen is that the bright yellow line there on top is total sales or total revenue, total dealer revenue. And what we actually see is that for our average dealer, most dealers are back to where they were at their high. Whether their high was 13 or 14, most dealers are back to that. A lot of times, though, I think people would say, well, that's not me. And how do dealers get there? And I'll fully admit, Marc I think would agree. A lot of that's because many dealers have gone through some form of a merger, or they've acquired somebody, acquired a neighboring dealer, and that's helped get them to there. If we looked at organic revenue, we would see that we're obviously in this upswing on the cycle part, but not at the same level. On the next slide, then, it brings us to another way to look at similar data, and that is to say, well, if we set 2013 at our benchmark over there on the left, those first set of 6 colored columns, and we just said that's our benchmark, what were the different departments within the dealerships, and how did those proportions of revenue change? And so throughout this cycle, what we've seen, and many of you have experienced this, is we have seen both new sales and used sales decline. Those would be our bright blue lines and our orange lines, which of course combine to make as a percentage our whole goods sales, the gray line. And so the gray line today, total whole goods sales, would be 91%. If we look over on the far right, that's our rolling 12 period for June 30th of 19. So it would be July 1 of 18 through June 30 of 19. Whole goods sales are still down 9% from the high. They were down as low as 55% back in 16. And so when we talk with a lot of dealers, many still feel like, from a cycle perspective, that recovery hasn't happened because they feel like, well, I'm still not selling as much. But if you look at the bright yellow lines and the light blue lines, those are going to be parts and service. And so what we've seen is dealers that have managed to get total revenue, green line over on the far right, back up to the same level as 13 and 14, have done that again, one through mergers, acquisitions, and the other major contributor to that is through a focus on parts and service. And I think on the phone, all of us would know that's pretty good news, because not generally, that's always better margin than new and used in the ag equipment business.
We always joke with our dealers that I'd much rather have my product mix lean towards 67% gross margin than 3% or negative margin. I think the other thing I just wanted to make sure everybody heard in there that you said, Clinton, I'm sure they did, was that we thought about taking the merger data out of there. However, every one of our dealers, save maybe 10-15% of them, have gone through some version of a merger, even if that just means they added one store. Some of them added lots of stores, but everybody has added at least some version of growth through merger. And so it winds up just being a normal part of business. And much like we'll talk with the rest of this presentation about how to manage growth, that is also the growth you have to manage. When you all of a sudden add in a few stores and you might lean towards adding a bunch of people or adding a bunch of more expense and things like that, you have to manage that just like you would organic growth. So I think it's important to leave it in there. Yeah,
I think it's absolutely. That's another one of those trends that is going on in the industry that's not going to turn away, not going to turn back. So this next chart here looks at the exact same data, just maybe instead of looking at it from the sides, kind of looking at it from the top here. And that is looking at what percentage of sales from the dealership come from new, what percentage come from used, what percentage come from parts, what percentage comes from service. And again, to Marc's point, there, in 2013, if we added parts and service, those are the top two colored sections there, the yellow and the green, that's 16.5%. But when we move out even just a few years to 2016, those numbers increased to 25%. Now, that increase happens mathematically because revenue goes down in the other two categories, but then it sustains itself as it comes out all the way through the rolling 12 through middle of 19, which means parts and service is growing not just as a percentage, but actually as hard dollars, which somewhat makes sense when we think about sales going down, where we have an aging fleet that's occurred. In fact, only recently in the last several months have we seen the age of the fleet start to go down a little bit, or maybe stabilize is a better word for that. But this is something that the successful dealers, the dealers that are dealing with both the downturn and through the recovery, they're maintaining this allocation of revenue into parts and service. So it's something that a lot of dealers, if they're not paying attention to it, it can really get away from them. If they are paying attention to it, it can really help them be successful. So that's kind of where we are in the current cycle and what we see from there. Marc, in terms of the trends and forecasts from the industry in general, why don't you kind of share with people what we've been looking at there?
Yeah, this is our take on data trends and forecasting. One of the things that we do with our dealers is we meet with them on a quarterly basis to talk about, what are they facing coming up versus what have they just come through. As accountants, we tend to look at what they've just come through, and it's always easy to look in the rearview mirror and say, you should have done it this way. It's a lot easier, or it's a lot harder to look forward and say, give solid advice about what can be done to make the future look better. But that's what all dealers want to hear. And so one of the things that we like to do is there's a ton of data out there, whether you're looking at sentiment reports that are put out by various universities, if you're looking at some economic reports that come out from the USDA or from the OEMs, banks and investing brokers and things like that. You can get a lot of data. What we then find is can be so much data that it's hard to understand. So what are you saying, Marc, about me as one of your dealership clients? And so what we have done here is we go through on a quarterly basis and we read all those for our dealers and put together kind of our overall barometer. We have one of these similar that we do for our construction dealers, but this one is for ag dealers. And the thing is iron, and to much extent. So both sides need to look at both sides of the economy. So in this one, you'll see on the left, the general economy, it's still very important, even if you're just an ag dealer. So looking at things like disposable income, new housing starts, and non-auto durable spending, those are all leading indicators of, do people have money to spend on things that we'd like to think they need a lot, but maybe they don't need as much as they could. Maybe they don't need a new mower or a new small tractor and things like that. So it really drives, the under 40 horsepower small tractors and ag equipment, as well as the lawn and garden equipment and the turf equipment and things like that. And so those are very important, and all of those are strong. For the most part, there was a little hiccup early in the year on single-family home sales. It started to dip a little bit, but just in single-digit dips. And so those are very, very strong. The ag indicators are on the right. And so, commodity prices, obviously, those are the things that we can all get depressed about, the longer we study those, because it's such a long, slow growth cycle or not growth cycle. We look at a lot of the ag economics as far as farmland prices, farming bankruptcies, the lenders' outlooks on whether or not they want to lend, as well as those sentiment reports, and then the movement and the growth of large ag equipment, small ag equipment, new sales orders and deliveries. And even though you see some red in there, we still see that those are actually, believe it or not, trending correctly. Just don't ask a farmer. There's that commercial a while back that talked about just ask a farmer. In this case, don't ask a farmer, because for some reason, the farmer sentiments right now are still very bad. Now it's because of commodity prices and tariffs and all those kind of things that are weighing heavily on them. And so that's the sentiment reports are starting to possibly look like they're rebounding towards the end of the year, but for the first part of the year, they were a little depressing to read. But overall, that's a fairly strong indicator. As you can see in the middle section there, that's our overall barometer. And we're still seeing between now and the end of 2020, somewhere in the neighborhood of 5 to 8% growth. And the reason that's yellow, because a lot of times we'd say 5 to 8% growth, holy cow, give it to me every day. Sometimes 5 to 8% growth is what it takes just to get past the cost of recovering from all the costs you cut when you were down. And we'll talk a little bit more about that. In fact, that's what today's presentation is really about, is how to recover when our sales are going up. So, but yellow, 5 to 8% growth. When we're solid in green, things are looking pretty solid.
Hey, Mark, I might add a comment in there when you were talking about customer sentiment in terms of farmers being pretty low on sentiment. You know, earlier this year we had a really bizarre weather cycle, or weather pattern, if you will, across most of the U.S. from the Rockies all the way to the Appalachian Mountains. I mean, almost everything in between. It seemed like we got really, really wet most of the year, and then things just dried up in July. And so I think a lot of farmers had pretty low sentiment because they were late getting in the fields, or what they had put in the field got washed out, and then they were late getting into the fields for harvest this fall. But wouldn't you say that from the things you've seen from Purdue and Creighton and some of the other research centers that we look for, there has been an uptick in that sentiment maybe in the last 2 months as they've gotten in the field for harvest?
Yeah, it was actually, so we went through a period where everything looks low right now, also maybe falsely, because after 2016, when we headed into that election, everything was rocky. There was a lot of unknown. It left those sentiment reports really low. And then all of a sudden the election was over. And whether you like the results of that election or not, this isn't a political statement. It was that the election was over. And so now all of a sudden it's over, and maybe we know what's going on. And those sentiment reports really bumped up high. And they got to all-time highs of, like, when we look at it, it's 100 means basically growth. And they were like in the 170 range, and they hung out there for a while. This year, they've been in the low hundreds, and they had been declining for much of the early parts of the year, like Clinton said, during that rain, when there was some good crop news, which meant bad weather news that produced good crop prices in June. It spiked up a little bit, right in time for some tariff stuff that then shot that down through the summer. But then interest rates got cut and they come back up again. So they're really hovering right at about 120, if I remember right, at the end of September. So they are again over that 100 mark, leading towards future expansion.
Mm-hmm.
So the other thing I want to look at, so the general economy right now, we hear a lot of people say around the country that they're concerned a recession is looming. And it does feel like that. I mean, everybody talks about when's the shoe going to drop and those kind of things. So much of that's because there's a 24-hour news cycle. There's a presidential election starting again. That's starting to kick into high gear. Like it or not, that's less than a year away at this point. So we've got a long year ahead of us that's going to produce a lot of mixed news and unknown sentiment. The other part of that is because this economy's been on a growth pattern for now almost 11 years. So from 2009 to 2019, actually the end of 2008, September of 2008 is when it started rebounding to now. So that's 11 years. Longest, as you can see there on the left. Before that, the longest one was from 91 to 2001. So it was a few less months than now, and so on. So this is the longest growth period ever. And so everybody says what goes up has to come down, and all good things must come to an end, and all that kind of stuff. And so that's why we hear, another reason we hear people talk about a recession. But what you see there on the right is the very bottom one is the cycle we're in now. So it has been a long run, but it's been a 2.3% run. And so that is a very sustainable amount. We'd like to see higher growth, yes, but higher growth usually means it doesn't last as long. And so at 2.3%, most of these economists feel like this thing can go another few years. And so earlier this year, we saw some slight signs that it was going to slow down. Again, most of that was housing started decreasing. And if you think about it, in the last 2 years, there's been a lot of interest rate hikes that kind of led to that. Well, this year, they've started decreasing the interest rates again. And there's news that there'll probably be another one yet this year. And so that has made the housing starts rebound, and that seems to fix almost everything when it comes to economics on the general economy side. So long sustained growth here, probably can go a little bit longer. In fact, this slide was brought to you by Wells Fargo, and I stole it from a presentation that we went to that I had permission to steal it from. So, and he had used the word, it's recession. We're currently in a recession-proof time frame because of that. The growth rate is low, and from the standpoint of most of our growth, 70% of the economy, in fact, is based on consumer spending. Consumer spending is based on jobs and wages, and right now everybody that wants to be employed is employed, and wages have been increasing as of late. So again, economists say possibly recession-proof. Granted, they're not ag economists, but that could be a sign that we got at least kind of the same amount of general economy growth for the next couple of years that we've seen over the last few years.
Now, just for the record, Mark, he was the one that said we were in a recession-proof economy, not you and me,
yep,
right?
On the record, Wells Fargo said that, not Marc Johnson.
So this next slide here is probably a little hard to read because I know we tried to squeeze 4 charts on here, but the left half of the page is the construction equipment industry. The right half of the page is the ag equipment industry. And so what you look at here when you see this longer term chart, that's the last 20 years in the upper left hand corner there for the construction machinery equipment. This has to do with the number of machines that were shipped. Remember earlier I said that industry has a more well-defined set of trends, oftentimes with a higher high and a lower low.
And a shorter cycle, usually a 3 to 5 year cycle.
Per cycle, yeah, thank you. But you can also see over on the right-hand side, on the upper right-hand, we see ag. Now, the nice thing that we see is that we do see an upward trend line on both, and that's just the dark line there that's drawn for both. The ag trend line is actually a little higher than the construction equipment, but they're both growing. Now, down below in the bottom half on the left-hand side, what we're looking at here is inventory levels. And so what we see is on the construction side, we see an increasing inventory level over the last 20 years typically. Now, a lot of that is probably because many construction equipment dealers, when they think about inventory, they also include their rental fleet in that. And rental fleets have really bloomed. They've just blossomed, bloomed, exploded, whatever word we want to use there, especially over the last 5 or 6 years. On the ag side, we've actually have seen decreasing inventory levels over this period. You can see how the trend line there is plotted on the way down. We're a little high right now at 1.74, but still the trend line would be sloping to the right. I will say this, Mark and I have gotten a lot of questions lately about when we're thinking about the forecasts and we're thinking about how dealers are reacting to changes from customers. This question about renting ag equipment just keeps coming up and coming up and coming up. And we do have some clients that are actually entering that market people have done leasing for a long time. I'm not talking about that. I'm talking about like true rental activity from the perspective of more the way construction dealers do it. It's a risk, that's for sure. Probably something else that needs a lot more time spent talking about it, but it is something that dealers that are wanting to think about how do you deal with a rebound, rental fleet is something they're talking about. On this next slide here, though, this comes from Ag Equipment Intelligence here, who's presenting our webinar today. These are some research that they have shared. And when you look at the 3 circles across the top, the thing that really stood out to Mark and I when we looked at that is 2020 is on the left, 2019 is in the middle, 2018 is on the right there. But what stood out to us was when you look at 2020, almost half of the respondents said they feel they will grow between now and 2020. And more than a third then said they thought they'd be flat. So it's interesting when we talk to dealers and they're talking about a rebound, that would tell us almost half the dealers believe a rebound is coming. A third think, maybe not a rebound, but we're not going down. And really only about 20% would actually say they would anticipate a decline. What's also interesting to us when we look at this chart is when you look over on the right and these dealer issues and concerns, in the latest survey, the number one thing was the increasing cost of new equipment. And so we won't go back a slide, but if we did go back one, remember we would see both construction and equipment and agriculture equipment deliveries increasing, which the laws of supply and demand would say that means there's more demand, which means price increases are going to continue. So this isn't something we see from a trend perspective that going away. What we have heard from, well, some clients, it would be their manufacturer, and other clients, it would be their competitors' manufacturers. We have heard of some manufacturers giving a lot of incentives to their dealers to help move equipment. And that's not new. Many have done that for a long time, but it seems like you have some manufacturers that say, all right, this is our incentive program, and here's what it looks like, and it's available to most everyone. We'll just kind of say all for the moment. But these have been much more specific manufacturers giving specific dealers certain programs because they're wanting to buy market share. And that's where Marc's going to take us here in a minute, is talking about how do dealers deal with this pressure from manufacturers to gain market share because they perceive a rebound is coming. They're looking at the general overall economy. What's interesting, though, before we go there, I guess I have a couple more points on this slide. One of them is that bullet point number 2 and 3, technician availability and then finding and retaining new personnel. Those are issues number 2 and 3. They were 1 and 4, so they're still top of mind to everybody. I would say anecdotally, we've heard a little bit of a decline in terms of people's dealers' concern over finding technicians. I think that's still an issue for most of them, but I feel like the ones that have kind of solved that from a perspective of not just pay, because at the end of the day, pay rarely keeps somebody long term, but from the perspective of providing a better work environment, I think has helped ease some of that pressure for the ones that have figured that out. And for the ones that haven't, it's probably made their lives worse because they're having to deal with competing against that now. On the next slide, we look at net farm income. This comes from the USDA and from Farm Bureau. And so this is an interesting chart because, again, it only goes back 20 years, but obviously they have data back much further than that. But what's shown here is the last 20 years. And when we look at the last 20 years and see that 2019 is expected to be 80 billion, we look at that and say, well, there's only 4 years that were higher than that. So are we really in our 5th highest year? And if so, why is customer sentiment where it is? And why is equipment dealer sentiment where it is? Marc and I were talking about that the other day, though, and he pointed out that these aren't inflationary adjusted dollars. When you put an inflationary adjustment on there or some kind of CPI type index to it, what we actually find is that 88 billion is still quite a bit lower than many of those years, even 15, 20 years ago.
I think the other thing on this, Clinton, is in particular in 2019, such a large chunk of it is from the market payments. For the government stepping in over tariffs and or weather events. And so that's a little larger percent than normal.
Yeah. Well, and also when you think about from a CPI perspective, that not having as much buying power due to the fact that labor costs are higher and due to the fact that equipment does cost more, farmers just aren't. They may have more dollars in their pocket, but those dollars aren't going as far.
Yeah, there's the Purdue sentiment report. They have a section in it about, is it a good time or a bad time to buy to make big purchases right now, whether that's equipment.
Right.
We always hear equipment, but it's big purchases. So it's also land and buildings and things like that. I always hear equipment though. And the numbers have been really high all year long, and they're still really high. And I think it's like something like 62% of the respondents to that survey say, yeah, this is a horrible time to buy big equipment, which is bad news for the people on this phone.
Right. So this next slide, you could go do this Google search on your own. This is just kind of Marc and I were looking for a visual way to get an overview. So we just Googled 2020 farm income forecast and clicked on images. And the one thing you do see, these are from a lot of different sources. I mean, I can see Creighton in there. I can see Ag Equipment Intelligence in there. I see some of the slides we've used here, but we do notice most of them have a trend that we are either trending up or we are trending up and flat. We're not seeing anybody in there who thinks, all right, we have another pullback coming. So Mark, when people start to see that, especially when the manufacturers start to see that, they start to put pressure on the dealers to go gain market share. Go gain more of this good economy that we do have going on. It is 35 minutes after the hour, Mark. So we've got 2 examples to work through pretty quickly. But why don't you walk us through both of those that kind of compare 2 different dealers. One that takes the approach of, hey, I want to go out and win and get big because that's how I think I make a bunch of money. And one that says, let me keep my eye on the ball and I'll worry more about making profit than making revenue.
Yeah, and just for the record, this is real dealers data heading into now, with me rounding the numbers off just enough so that if they are on this phone call, which I don't know they are, they won't recognize themselves. But it is actual dealer data. This is a bullseye report that we put together as part of that quarterly meeting that I talked about earlier, just to help dealers understand where are the areas that they could be working on right now to make the biggest impact. So the example we're going to walk through for the next couple of slides is this dealer here. And so this is what you need to know about them. They're a large ag dealer, less than $100 million in revenue. So right now, very focused on gaining market share. So like many of the people on this phone call, their new inventory has spiked this year because they were trying to please the manufacturer and order a bunch of new equipment, and now they're working through selling that. So very market share focused. Their margins, absorption, net return on sales, all of that are okay. But as you can see from this bullseye, some of them are on the outer rings of that. So they're okay, but average currently. They would, like many dealers, blame that on the downturn. This is a client, this one particularly, I didn't go back to 13 or 14, mainly because I didn't have this bullseye chart back in 13, 14. We started this in 15 and 16 as a result of the 65% downturn in 14 to talk about where can we really be working. But so I don't know if they were on the fringes back then, but they are now, and they would blame that on the downturn. So our question for the rest of this presentation is, what if the rebound is now? And they don't adjust. Most people would think that a rebound plus fixing my market share means I'm winning, but is it? Might be losing. So the assumptions I'm going to walk through now to show you what happens to the same dealer, remember how that bullseye looked, was that let's assume that there's going to be 30% industry sales growth in 2019 and 2022 through 2021, about 10-15% of growth. Notice I'm saying let's assume that. I'm not projecting that. I'm not going to be held accountable to that forecast, or that's just an assumption right now. Because at some point, the age of the fleet discussions and the discussions that we're hearing from some economists is there is significant sales growth out there on the horizon sometime. The problem is we heard in 17 that it was going to be in 18, and there was some bump up in 18, but that was major league fleet corrections. We heard in 18 it might be going to skip 19 and go on into 20, and we heard in 19 that it might be in 20 or 21. So we don't know when it's going to be, but let's assume for a second we're going to have this 30% growth. This particular dealer is going to continue. We're going to go through the bad news first here. This is why we're calling this one losing by winning. So this dealer is going to continue his market share maintenance and growth at the cost of whatever that takes, because many people think this rising sales fixes everything. And so he's going to do this. Not going to make any changes to trade-in policies or use production management. And he's not going to do anything to fix the fact that an increase in industry growth for sales of equipment is going to decrease the sales mix for parts and services. Also isn't going to make any change in the way he's got available lines of credit to borrow from or capital available from his owners. And so what happens is we go through 1 year of this growth, about 15% growth, again at the industry level, and we increase our market share. And 2020 looks worse than that bullseye I showed you a second ago in 2019, but not necessarily horrible. I mean, enough that we got a lot of sales growth, So all the ego factor in there that, oh, my sales increased by 15%, I'm doing something right, might have wooed you into a false sense of things are good. Another year of that, though, 2021, and you see things really start to fall apart. So we have just used all the same drivers and just an increase in sales, but not increasing the sales mix and things like that. And just look what happens. Not only do our hard results like gross profit on new and used move out past the bullseye, but so do other things like our used inventory levels, our used inventory as a percent of equity, all of these things that we would want to be solid in that bullseye, no matter where our growth pattern is at, they all start to scatter and get uncontrollable. If you remember back a couple slides, there were 3 or 4 things that this dealer needed to manage to fix the boat. In 2021, there are so many things outside of that bullseye. It feels a lot like 2014 did after the 2013 high to say, what do we do now? Because everything is bad. In fact, it looks even worse when you look in at the actual balance sheets and income statements. I would argue that the cash flow statement is the most important one to look at when you're looking at a forecast, but it takes me way too long to explain a cash flow statement to most people. So I'm showing you the important parts here on the balance sheet. And so you can see the big things that happened I've highlighted. So on the balance sheet, for instance, ignore the fact that your cash goes negative. You could borrow that up and fix that. So that isn't necessarily that dealer went bankrupt. It's just their way of financing, which was about 50% of their floor plan was financed, and they had equity in the rest of it. That continued to stay at that level because remember I said we didn't make any changes, and so their cash flow hurt. Now they could fix it, but you can see why, because their inventory explodes, goes from $30 million in 2019 to $45 million in 2022, and a lot of that in used. And so it starts leading back to the same things that led to the 15 downturn. Also on the balance sheet, then at the very bottom, you can see what happens to their profit, obviously, and their equity. And their equity just continues to go down. That also would drag down their valuation if a merger or an acquisition happened during that time. And so all of a sudden they're in trouble there. You see there on the right what happens to the income statement over that 5 years. And yes, we grew our revenue. We went from $90 million in 2019 to $130 million in 2022. And so that feels really good, right? To grow in sales. In fact, I've got a dealer here in Kansas that they hit their all-time high in 2014 of like $128 million. And they haven't been there since, and they have made twice to almost 3 times the amount of money now that they made back in 2013 and 14 when they were at 128 million. So sales is not the best achievement result in all cases, because you'll go to the bottom of that income statement, you can see that we go from making $2 million to losing $2 million really quickly. And the other thing to keep in mind is we only showed this growth in 2020 and 21. And then 2022, we put in drivers similar to 2019 to say, go back, and now we're going to have single-digit growth, and we're going to manage our used production, and we're not going to chase margin. But look what happens still. It takes us a couple years even to get over that hangover of the 2020 and 21. So if you think back in 13 and 14, that's what the 2020 and 21 looked like, and it repeats itself. So that's kind of the point of this, is we don't want to repeat how we handled the highs of 2013 and 14.
So this next slide I'm going to breeze through pretty quickly, but it's a very interesting slide. And again, this is from real data from the customers that Mark and I work with specifically. The bright orange there the bright yellow down at the bottom is total overall margin for dealerships. So this is all departments combined, and it's graphed against the numbers on the right. So back in 2013, which again, was for many dealers was their high, they were making barely any margin at all. Barely any total margin. And yet now most of the dealers they were at 10%. I was looking at the left. Yeah, I was like, that doesn't make sense. They were a little over 10% margin, total margin. Many of them now are in the upper teens, have almost doubled that. And then from there, you can look at the chart yourself. I mean, the green line parts, the kind of mustard color At the top there is service. Those are all benchmarked against the right index over there, and those are actual results. So service margins, 60-65% range. Parts somewhere in the mid 30s is holding. Both those have held pretty well, but we see the big swings, which are benchmarked against the left side of new and used, which of course combined for your whole goods margin. And we've seen those in 2013, 14, 15 declining, but as dealers have worked through that, and that's really what it was working through all that inventory, they've been able to bring that margin back up to where both new and used is somewhere around 6, almost 7% for dealers for 2018. And for 2019, it'll be interesting to see how that ends up, because while it is a rolling 12, it seems like spreading out over 2 years, and we kind of see this throughout the middle of the year. A lot of times, things will start to look a little off. Although I would say it wouldn't surprise us if we have a little bit of shrinkage on margin. Although I don't think it'll wind up quite as drastic as it looks in this picture. The next slide, again, I'm going to cover pretty fast, but it's the same type of idea we did earlier, and that is if we benchmarked 2013 across all the departments of the dealerships and said that's 100%, then where have the margins ended up being along the way? And there again, we'll just skip all the way over to 2018, which is kind of that second big block from the right, and we're going to see that new margins are about 50% higher than they were back then, because they're at 150% now. Used margins are 6 times what they were in 2013. But parts and service have held. And so our total margin is about 60% higher. It's the green of 2018. It says 160.69%. This is actual real data, where total margin is almost 61% higher than it was in 2013, because the sales mix has changed so much.
Yeah, we can't obviously speak for all dealers, and we can't claim credit for this. What we can say though is that every one of these dealers, because they're on our list, do look at this information and manage to these numbers, because we go over it with them every quarter.
Yep.
And so again, I'm not at all claiming credit for any of this. We just facilitate meetings. But I think the important thing is when you manage to something, things get managed. And if you just kind of let them happen and think that sales fixes everything, then the opposite is true. And that's, again, what we don't want to have happen if in fact we are headed towards a recovery. And so again, surviving a rebound. What does winning and surviving look like? So I got the same dealer here that, the same 30% industry, the same market share maintenance and growth focus, but margins are maintained, and really focused on I'm not gonna let the market drive that. I'm gonna let the margin drive that. I'm gonna manage my trade-in policies and my used production to make sure I don't give away everything I made on new just to grow my used fleet. And how am I gonna make sure that I grow my sales and my parts at the same time I'm growing my revenue? And what happens then is that same dealer, remember how spread apart the bullseye got in 2021, particularly. Here again, this dealer, by focusing on the margins, those bullseyes look very similar. In fact, it almost looks like they're the same. They're not. The numbers are just slightly different on here. But they are, maintaining margins fixes this kind of stuff. And the things that they were already struggling on, they haven't necessarily fixed those, because it's very hard to fix things before that you were doing wrong before the recovery in a time where you're selling like crazy, because you barely have time to take a breath and look at things. That's what happens with increased sales. The other thing is that you guys have cut so much cost in the last 2 or 3 years that any recovery is going to take some more cost. And so you got to manage what it is that I'm willing to spend and invest on this investment. The balance sheet and income statements, again, here you can see this dealer all of a sudden is building cash again, is maintaining inventory. Profits are not completely going up every year. You see some struggles here, but the main thing I'd like to point out in this one is revenue is still increasing. And what you'll see is if you compared it back to the few slides before, it's just it's not increasing by about $1 million to $3 million. So what we find is that last $1 million or $2 million of revenue that we're all after on those last few digits of market share, they're the most expensive, which means they're also the most avoidable.
Yeah. So as we wrap up here, Marc, you might hit just kind of those first few bullet points, and then we can leave some time for questions.
Yeah, I think, again, are you ready for a turnaround? Certainly everyone is. We would argue that maybe we've already seen a little bit of that turnaround and just didn't recognize it, kind of like the frog that accidentally gets boiled in the cold water. But maybe we've seen some of that, but certainly there's some more to come. But the important part is increasing your sales is not managing your business. Another one is don't beat up your neighbor just to beat up yourself. That's the whole lose by winning thing. And we see this, and it's not just with competitors and different OEMs. It is inline competition with the same OEM. You guys tend to beat yourself up just to beat your neighbor, and sometimes let your neighbor win, and he'll lose instead of you. The other thing I say is be careful of, we talk about trade wars and tariffs. This is a different trade war. Be careful of getting in the middle of trade wars, because there are some big OEM trade wars out there. And if I got any OEMs on the phone, I'm not trying to make this sound worse than it is, but man, sometimes the OEMs go after, they throw some stuff in there to help you get market share, to help them get market share in that area that could just be disastrous for you. So just be careful of getting in the middle of that. Getting that one deal might be great this year, but when they come back to roll that again in 3 or 4 years, they're going to expect that same deal, and you might not get the OEM's help at that point.
Yeah. So at this point, you know, the next slide here is our last slide, and it just shows a link to something that Marc and I do. It's called Stories from the Road. And again, these are little 5-minute videos that talk about many of the things we've talked about today, but it takes them kind of in little bite-sized chunks. That if you haven't signed up for that, you can. It's completely free. You'll get it. We won't even know it. But with that, Dave, I want to turn it back over to you and see what questions people have that we could answer.
Okay, thank you, Marc and Clinton. This was an eye-opening webinar for me, and we did receive a few questions. The first is, should dealers be looking to add to spare parts inventory at this time? With cash outlays for new equipment inventory down, it seems that a good investment would be to be ready for higher margin parts and service sales by building inventory. In the past, once the OEMs start ramping up production, the supply chain for parts will shift their focus to the production factories, and dealers struggle to get parts for service. Can we get ahead of this now?
Yeah, I think certainly pay attention to your fill rates. You know, if you see over time that you're below where you ought to be, you know, like if you're in the 60-70% fill rate, then obviously you need to build up your parts inventory. I think the one thing that you need to be careful of, particularly in light of the mergers and acquisitions that have happened, is if you've gone from being a 2 or 3 store dealer to a 10 or 12 store dealer or a 20+ store dealer, then all of a sudden stocking every single one of those stores to the appropriate fill rate might get extremely expensive. And so you really need to pay attention to the parts in each one of those stores, and how mobile can you be between stores? Can you stock one of them a little higher than others and move things around with mobile part ordering and things like that? Certainly you don't want to be in a position where a customer wants something and you don't have it, so they go online or they go to your competitor, because that's just opening the door for them to like the competitor. Maybe their popcorn is better than your popcorn and they never come back. So yes, definitely get your parts up to adequate fill rate, and then just be careful not to go too much past that.
Okay, the next question. Can you give more color on the large equipment being in the green? Large four-wheel drive sector seems to be hit hard with all the trade agreement and commodity price headwinds.
Yeah, I think I would agree with the four-wheel drive part. That's when you look at the large ag stuff, there's still some large ag out there that's not four-wheel drive. When you look at the reports coming out from the associated equipment manufacturers and things like that. What we're looking at there, that the main thing on that green is what does the year-over-year sales still look like right now for and orders for the new equipment. And except for four-wheel drives, those numbers are all up. Combines are up, the high horsepower two-wheel drives and things like that. And so yes, there is one sector in there, the four-wheel drives, and from my understanding, and I won't say which color or more than one color, but there has been some performance issues even in some of the four-wheel drive things, and I think that might have driven some of the sales issues and just the overall price. When you're talking about a machine that's that many hundreds of thousands of dollars, it's harder to move that. Further, the multi-unit discounts, those have tightened up, and so the really big machines and the four-wheel drives are a little bit harder to move. Also, parts of the country where the four-wheel drives are moving, there's been other big ag that has replaced. So like the cotton picker machines and things like that, those have really rebounded over the last few years. And so it's a matter of where do I spend my money. So I think I would agree with whoever asked the question. Four-wheel drives have seemed to have some problems, but the rest of the large ag has seen some pretty good numbers.
Yeah, Mark, if I remember that report right, I think even four-wheel drives were, everything else was positive other than those, and those I think were right around 0 on a rolling 12, year-over-year comparison. But that's, like you said, that's down compared to everything else.
Okay, I wanted to ask a question for myself, and that is, if the China trade dispute were to end, let's say, in the next month, and they got an agreement, at least on the phase 1 portion, how long do you think it would take for farmers to start buying new equipment?
I thought you were going to ask if they approved it next month, how long would it take for it to unravel and they need to approve a new one? That might be a quick answer too. That's a fluid situation for sure. We've seen a lot of reports here recently that the age of the fleet right now is actually higher than it's been in a long time. And so I think if there was cash in a farmer's pocket, and a forecast that said, hey, we fixed this China thing, we've got soybeans and corn moving, I think you would see a fairly quick turnaround for that. And that is actually one of the concerns we would have right now is, so the inventory is up right now across dealers, but it's up in small ag, small new ag. It's actually down except for the dealers in trouble, it is down for most big dealers, and used inventory is also at a point where we see the used production rate right now at a point where we've got dealers with some parking lots that are starting to look quite empty. And so if it did rebound quickly, it might be one of those that we have a hard time filling it. So whether the farmer is asking for it and we're able to service it all might be another question as well.
Okay, excuse me. Here's the last question. What impact do you think the backlog of lease returns are going to have on the used market?
That is definitely a wild card. I always joke with our dealers that there was a cash for clunkers deal that the government did a few years back with the used cars, and at some point that is what could be the result of lease returns. I don't know the answer to that. Honestly, there's some numbers out there that are a little confusing to look at, how much faith you have in them, about how much there's actually there. Some of the really large dealers and the OEMs themselves have quite a bit of backlog, but I don't honestly know the answer to that. Certainly with that much equipment, it's going to get sold somewhere. And it depends on who sells it and what haircut they're willing to take and where it goes as to how that's going to impact the area around them. The good news is they're still going to need parts and service. They're still going to need traded in a few years, and with the recent cuts by the manufacturers in the new, it could work itself out over a couple of years, because we've seen both Deere and Case, for instance, cut production in their ag equipment, and so that could wind up being something that catches up to itself over the next 18 to 24 months.
Okay, this is all the time we have today. Today's presentation and audio will be made available on the Ag Equipment Intelligence website. if you'd like to go back and review it. Watch your email and the Ag Equipment Intelligence newsletter for more information. I'd also like to remind our webinar attendees of the upcoming Ag Equipment Intelligence 2020 Executive Briefings virtual event that will be held on December 11th. This is the first event of its kind from Ag Equipment Intelligence, and it will feature some of the best farmers, farm equipment dealers, and equipment manufacturers who will offer their perspectives on current business conditions and outlook for 2020. For more information, please go to agequipmentintelligence.com/2020 executive briefing. On behalf of Marc Johnson, Clinton Baker, Coe Isom, and the staff of Ag Equipment Intelligence, thanks for joining us today. When you leave the webinar, you will be directed to a short survey. Please feel free to reach out and to let us know what you thought of this live event and what other topics you'd like us to cover in future webinars. Thanks again, everyone. Enjoy the rest of your day.